Are we going to see a Tesla stock crash in 2020? If Tesla stock does crash, how low will it go? This video will give real fundamental analysis, not just wild speculation. Firstly, what needs to be said, Tesla's promise of a self-driving, fully autonomous car is more than 10 years away. A Morgan Stanley analyst recently said that when he talked to the scientific and tech communities, the consensus is that replacing a human driver has been described as the hardest technological challenge humanity has ever attempted. And really, when you talk to the lawyers, they say that it's the most complicated moral, legal, and ethical challenge that any lawyer has ever addressed. What's priced into Tesla right now? And where will the stock go if we see a Tesla stock crash in 2020? What's in the price right now is something approaching 4 million units of annual volume by the year 2030 at a 15% EBITDA margin. So they will have a margin roughly 2 times the auto industry average, but at a volume of about 40 to 50% the volume of Toyota. However, that's just if you look at it like a auto company. How many cars did they make? Volume times the average margin that they keep on each car. Cars in, cars out, bam. But when you consider it as a tech company, you aren't just looking at number of units sold times price or margin. When we're looking at tech, we're thinking of users, recurring revenue. Do they become a battery supplier to the world's automakers? We can compare Tesla's EV to EBITDA ratio. EV is calculated as market cap plus debt, preferred stock, and minority interest minus cash. And EBITDA is, of course, earnings before interest, taxes, depreciation, and amortization. Essentially a simple measure of a company's overall financial performance. So if we're looking at Tesla as a growth stock, then we'll look at their 2025 EV to EBITDA ratio. And when we do that, we get this. Simply put, Morgan Stanley estimates Tesla is more expensive with lower growth than Amazon, is more expensive but has a higher growth rate than Apple or Netflix, and is cheaper than Spotify but has, quote, materially lower growth. So Morgan Stanley, putting the study together, stuck by its underweight rating on Tesla and its $360 price target on Tesla. That's more than 50% lower than where it's at right now as I'm making this. Keep in mind the shares appear more expensive than Amazon, Apple, and Netflix, even when using the analyst's cash flow and revenue estimates for 5 years from now, which are already, they say, very optimistic. What do you think? Is Tesla a bubble? Is Tesla stock going to crash? Are you long or short Tesla, and why? Let me know in the comments below.